Hello, everyone, and welcome to LPL Market Signals. Jeff Bookbinder here with my friend and colleague, Jeffrey Roach, with an economic outlook. So, Jeff, thanks for joining today. I'm glad you're here. This is an epic week of economic data, and there's another couple of dozen really important things going on at the same time. So, I'm interested to hear your thoughts, and I know our audience is too.
Well, it's interesting too when you think about where we are mid to late July, we really start building out expectations for 2026. Even though that sounds strange for some of our listeners, it is indeed the time starting to get the data for the first half of the year and setting expectations latter half and rolling into another year, 2026. Got to start practicing using that.
You got some more time. But you bring up a good point. The market is clearly trading off of 2026 already, right? You get some stimulus from the one big beautiful bill. You get kind of a lapping of the inflationary effects of tariffs. Tariffs are a bigger problem for 2025 than 2026. And then you give AI more time to play out for the productivity gains from AI investments to come through. So a lot to look forward to, I think, in 2026. But yeah, we got a lot of work to do to get through this year, especially now that we're in this kind of summer lull where stocks tend to not do very well. Hopefully, we'll buck that trend this year. Here's our agenda today. It's quick market recap. It looks the same as the recent market recaps. Stocks are going up. The economic outlook, Jeff, that's where you come in. You wrote the weekly market commentary for this week, sharing the economic outlook. And then week ahead, we kept our outline short and our slide presentation short, frankly, this week, because there is just so much to talk about this week. We'll call it one of the busiest weeks that you will ever see for market watchers. So it is July 28th, 2025 as we're recording this Monday afternoon, and stocks are kind of mixed at this point. But last week, we had a golden week, I will call it. I'm not sure if that's kind of an official term, but that's what I'm calling it. Every day last week saw S&P 500 gains.
Hey, it
Couple
was
of,
Golden Week because it was my birthday on Friday. I'll
oh,
throw that
that
out
too.
there.
An extra special golden week. I bet in the history of the markets, we've never had a golden week and your birthday together
That's
like this.
possible. That's
Uh,
possible. By the way, I do have to correct something. Right at the beginning of the outset, I said mid to late July, thinking about expectations in 2026. You know, there's nothing mid about where we are today. I just wanted to highlight that.
well, mid to late covers it.
Late. We are late July, July 28th, as you rightfully, accurately stated on this, Jeff. So
Very good.
appreciate that.
Gotta
Appreciate your
get
graciousness.
Gotta get those compliance disclaimers in. Keep those folks happy. So anyway, I'm going to call it a golden week. And again, S&P 500 up every day last week. That total 1.5% for the week. And, gains across the board and all these other indexes, although not quite as strong for the Dow and the NASDAQ. I think the two big catalysts, if you want to be general anyway, were earnings and trade deals. And specifically on earnings, certainly Alphabet, very high profile, raised their capital investment guidance, which I don't think too many people expected, and generated solid results. That was certainly a catalyst, but it was more than just Alphabet, right? It was, generally speaking, we've had a very good start to earnings season. And then trade deals, Jeff, I know we're going to talk about that when we get to your outlook, but Japan got a deal, and that sparked optimism that Europe would get one too. And sure enough, that's what we just saw. 15% for Japan, 15% for Europe, autos included. Market liked it.
Yeah, yeah. And the optimism is based not on previous years where the average effective tariff rate was in the 3 to 4% range. It's all about relative to the really horrific numbers that markets were trying to digest after April 2nd. So I think that's really important for our listeners. You think about, that 15% mid to upper teens, a lot better than what it could have been had the markets continued to be nervous about that worst case scenario, hence the catalyst for that sell off in early April.
Yeah, clearly the market's comfortable with where tariffs are likely to land, at least at this point. The sector winners last week, healthcare. I mean, healthcare has really struggled. In fact, it's flat year to date. That was some gains in medical equipment and some biotech strength. Probably nothing that's going to continue, but good to see that sector have a strong comeback after such a challenging year. Beyond that, it was a little bit more about economic sensitivity. So you had industrials, materials, financials do pretty well. Actually, communication services as well. By the way, communication services is one of the biggest sector beneficiaries of the One Big Beautiful Bill. A lot of R&D and a lot of capital equipment purchases where those tax credits, that accelerated depreciation is going to really help. So that continues to be a sector that we like, along with financials. And even though the dollar was up last week, we had gains pretty much across the board in international markets.
Yep.
Almost 2% gain in the MSCI EFA index, the developed international index, and almost 1% in EM. So sure, a couple of these markets were down a little bit. We still have some more trade deals to get, even though we've gotten through the bulk of our big trading partners. Generally speaking, it's just been the rising tide lifting all boats, Jeff.
Right. And you're starting to see some pretty decent numbers coming out of Japan, fundamental economics of manufacturing, consumer, inflation data. That's certainly building some of that support that you just referenced just earlier, as we saw some performance numbers, equity performance numbers out of Japan, certainly supportive by the data. A little bit different on Europe, still seeing some of the fundamental weakness, particularly industrial production and other retail business activity, particularly in Germany. But we're definitely seeing really the reason why asset allocators need to continue to keep an eye on the international components for their portfolios.
Yeah, no doubt international equity exposures helped folks boost portfolio returns this year, something we haven't seen in a long time. Turning to bonds, commodities, currencies, really nice gains for the bond market. And this is another piece of why stocks keep going up, is because the bond market's generally behaving. 10-year yield has stayed below 4.5%, despite all of these tariffs. I mean, the market's been worried about more than just tariffs, right? But when you for bond investors anyway, but when you combine the revenue from tariffs with the additional deficit spending from the OBBBA, say that 10 times fast, you actually end up with not really getting a worse deficit picture. So plus you're going to have the Treasury selling more T-bills, right? Shorter term debt as opposed to longer term Treasury debt. That makes it easier for the market to digest. So maybe the market is saying this bond market outlook is okay here, Jeff.
Yeah, we certainly don't want to see what we've seen in some of the previous years, where there was a little bit of a rotation and we had some bond temper tantrums. And as you remember in previous years, that's certainly something that ends up making investors a little bit nervous, want to take some of that risk appetite back down. We've not seen that. As you've said, the bond market seems to be behaving in a fairly stable fashion, particularly because I think the Fed has been very clear that they have the data to support their wait and see mentality. And I think it's important for our listeners to remember, this week's a big week, economic data, including a Fed meeting. Fed officials are going to have to start pivoting and explaining why and how they're going to manage the 3 additional meetings that they have later this year. And the better they communicate, the more calm they can exude to the markets. That's certainly going to support a continuation of the bond market behaving well, as you said.
Yeah, maybe the bond market doesn't need more than 2 cuts to continue to behave. We'll see if we get them this year, but that is certainly the base case for markets. I guess the commodities complex helped too, mostly contained or lower, and that certainly translates into lower bond yields, a little bit less inflation relative to when commodity prices rise. So all in all, pretty cooperative backdrop, I would say, for equities and for fixed income right now. Now that won't always be the case. At some point, this market's going to roll over. It has gone certainly farther than we thought it would go at this point. Here's the S&P 500 chart. We are overbought, not just mildly overbought. We are solidly overbought. 76 plus on the RSI 14. So as we've been saying for several weeks now, probably need a pause, consolidation, whatever you want to call it. But there's a lot of support here. You've got, certainly the 20-day and the 50-day, you've always got those as support when you're in an uptrend. But the previous high, 61.44 on the S&P 500, some of these other support lines that are drawn in here. So it's going to take a lot to get the S&P 500 to 5,800, which was our kind of prior pullback target. Probably have to raise that. We could still get there, but pretty good technical picture here, despite being overbought and maybe needing to cool off, we'll say. So that's about as good as a chart looks, though, and as good as an uptrend looks. So let's turn to your economic outlook, Jeff, and this is where we'll spend most of the time, although it might take us 10 minutes just to go through the week ahead because there's so much there. You call this comfortably numb. I think that probably fits because there's been so much potential for economic pain and the economy just isn't really feeling it.
Yeah, we highlighted in the weekly some of the catalysts to the upside, some of the pressures to the downside. If you want to use the headwinds, tailwinds monikers, I think that's helpful. And I think what's happening is investors are really saying, okay, we hear the good news, the tailwinds to the economy, and then we're just comfortably numb when we hear anything that might be headwinds to growth. So we tried to provide a big picture here in the weekly. One of the things that I started out with and basically just said, okay, one of the things that has been helpful in terms of understanding the cyclical nature of where the economy is and the business growth expansion cycles and patterns. The ISM numbers, which is basically generated from actual comments and surveys from purchasing managers from around the country, in addition to purchasing managers in a host of industries. So it's not just one look. This is a multifaceted look. That's done pretty well in identifying the ups and downs of the business cycle. And you can see in the last few months, you're certainly expecting that slowdown to happen. Now, granted, it's going to be a little bit dicey this week because we're going to get second quarter GDP. It's going to look really hot. That's just a payback from some of the front running of tariffs that were done particularly in March. So we had a negative print for Q1 GDP, and quarter on quarter annualized when you realize, hey, we didn't import as much this quarter like we did, particularly last quarter, as I said, you're going to have a much higher quarter on quarter number. So just be mindful. It's going to be a little bit of a head fake, but when you think about the first 6 months of the economy, 6 months, certainly there's been a slowdown, but it's been a measured slowdown. Hence, going back to the comfortably numb for investors. When investors see a bond market behaving well, as we just talked about just a little bit ago, and seeing an economy that's slowing down on a measured pace, that's certainly providing that environment for people to keep on being interested in putting on risk. You have cash in the sidelines. We actually talked about that earlier, Jeff, with another call that we did. But you think about that the measured pace of the slowdown. We haven't had many surprises. In fact, we'll get to that a little bit when we talk about the upcoming payroll report. Another time series that has not given us much surprises. Markets don't like surprises. So when they don't have to worry about surprises, that's certainly a good thing.
Yes, and the market probably doesn't have to worry too much about tariff surprises anymore because the number of countries that don't have a deal has dwindled.
Yeah, exactly. And what's been interesting too, as you think about this, Secretary of the Treasury Scott Bessent is in Scotland, I believe. Is that right? That's where they're going to be meeting with Chinese officials all week. So you can see the outlier here. I'm just showing a chart uh, based on our top trading partners. That's why Mexico, China, Canada, Germany, Japan are on the top right there. And the outlier, of course, is China. That's certainly providing a little bit of that uncertainty on where tariff rates are going to end up. Continuation of the negotiations, perhaps another delay. Who knows? It's been pushed out a few times as it relates to the U.S. China relationship and the uncertainty and the tension there still. But we got some good news over the weekend. Europe, certainly good news later in last week on Japan. And so the key takeaway in the commentary this week, Jeff, was just to say, we're definitely dealing with higher tariff rates than we were during Trump 1.0. But as long as we hover around that mid-teens on an average effective tariff rate, the economy can handle it. Now, granted, you could argue that that's a little bit of a tailwind to growth. Tariff is a tax, but we can handle something like that. Below 20%, anything above that, that's when the markets get nervous. Businesses think, okay, can we really handle that? That's where it gets a little more tenuous.
Yeah, if you have a 50% rate, which appears roughly where we're tracking now, it could still go up. We have sectoral tariffs to come. We have a number of countries, as I mentioned, that don't have a deal yet, and who knows where those go. But at 15%, you're talking about numbers that can be easily offset by the additional deficit spending from the One Big Beautiful Bill,
Hmm.
right? So I think that's why the market has really become comfortable with those types of numbers, even though it's 5x what we had last year, right? There's a massive increase in tariffs, but of course, some of our trading partners are absorbing that, and a lot of these frameworks are coming with investment in the U.S., right? But it's still going to be passed on to some extent to consumers. And it's still going to result, even though we've had a good earnings season so far, still going to result in some margin compression from US importers.
That's right. And that was one of the
Yeah.
things that caught my attention when I read the latest beige book out of the Fed. And just for our listeners, Beige Book is a compilation of what business owners are saying in all 12 districts of our country. So the Federal Reserve System is broken up into 12 districts, and San Francisco and Kansas City, et cetera, Dallas, going all the way over to New York, Atlanta, Richmond. A lot of comments in a lot of industries talking about a little bit of that concern on margins being compressed. And that's certainly one of the things that we need to be mindful and watchful of.
Yeah, certainly we've heard about that in the auto sector, probably the poster child for eating tariffs at this point. So
Mhm.
pretty big numbers. So thanks for that, Jeff. We'll keep watching this, but as long as we're in that mid-teens range for these, market's probably going to be pretty comfortable. I guess if you want to try to find a bullish catalyst here, I mean, Brazil is still operating under a 50% threat. So you could get good news there. There's really, I think we run a surplus with Brazil. So it should be like the UK in theory and have a low tariff rate. And then China's rate, if fentanyl tariffs come down in a Canada and Mexico negotiation, then maybe China's fentanyl tariffs can come down. Maybe we can encourage more investment by China in the US. Who knows? But I guess there's a possibility of that. We're just running out of upside catalyst opportunities as these countries continue to make deals, at least among the biggest trading partners. So next up, Jeff, is a little bit of a worrisome economic signal. The delinquency rates for credit cards and auto loans have been ticking up.
Yeah, that's right. So, we've had really two economies for the last several years, ever since the government shutdowns and the reopenings. It's been about people that had the flexibility to work hybrid work environment, the white collar workers ability to move around from job to job, get a pay raise by just switching. Uh, Upper incomes driving consumption, broadly speaking, in the US. Same thing about homeowners, right? Those that refied in 2021, certainly having a lot of extra discretionary income. Flip side is your subprime folks that are showing up in these specific numbers here. So if you look at the chart and you see that dip in 2021 in major delinquencies for credit cards, auto loans, that's really somewhat artificial because of the forbearance that was allowed under the CARES Act. But we're starting to see, as of the first quarter of 2025, pretty high rates of delinquencies as a percent of current balance, basically those that are 90 days plus past due. And so you track that relative to where we were in the great financial crisis. That's one of the warning signs that I think is just helpful to think about. And it's helpful as investors to remember, okay, it'll show up perhaps adding a little more risk in some areas, not necessarily everywhere, because just a reminder, when you think about this country, 2/3 driven by consumer spending. Well, within the consumer spending number, it's heavily driven by your middle and upper income households.
Yeah, this is kind of I guess the after effects of higher car prices post-COVID, right? Which made those loan balances a little bigger, and rising rates post-COVID, right? We know what happened there with the Fed, and you know, any market interest rate you want to look at in the last few years has gone up. So it's been tougher certainly for the
Yeah.
low income folks, but
Yeah.
maybe not a recession signal, but certainly something to watch.
Right. And just a reminder too that rising rates and inflation pressures hit lower income folks harder. And so that's just kind of another key takeaway.
Absolutely. All right, now for the big close, Jeff. We're going to talk about the 25 big things happening this week, give or take. No, we won't hit 25. We're going to hit maybe 10. The
That's right.
weekend,
That's
one of
right.
the busiest weeks you'll ever see. Yeah, it's unbelievable because not only do we have a lot of economic data, we have the China negotiations that you talked about earlier. We have court ruling on the legality of the tariffs under the IEEPA. Those might go to the Supreme Court, but it's possible that the tariffs that have been implemented under the IEEPA, the Emergency Powers Act, uh, those could be deemed illegal. In which case, the countries or the I guess whoever paid the tariffs could have a rebate, right? The U.S. importer, the U.S. company could be rebated those tariffs, which could be interesting. They'll probably go back on anyway, so don't think about that 15% tariff rate going down, because there are other legal angles for the Trump administration to use, and those look like they have a pretty good chance of sticking.
Hmm.
So, but it's just something else to watch this week in addition to all the data here. So, Jeff, walk us through the data. What should people and the Fed meeting? What should people be watching this week?
Yeah, so we're recording here, as you mentioned, on the 28th. So Tuesday, you'll get JOLTS numbers. The reason why it's a star here is JOLTS, Job Openings Labor Turnover Survey. I like to just say it tells us about what kind of churn is happening in the labor market. People coming and going, quitting one job, churning, moving to another job. Key takeaway here is, and this is important continuation to just monitor here, there's less churn in the market, meaning job market is slowing, meaning people are not as likely to quit one job to jump to another. The likelihood of just being successful in that is not as great as it was, say, a year, 2 years ago. So churn is slowing. That certainly can be a good thing on net. Just wanted to put that out there. So the next star is the GDP number. So the next day, on Wednesday here, we do get a number of things. First is we get a press conference after the Fed makes a statement. They're going to release a statement. It's very possible we might have one or two dissenting from I think, the prevailing decision, which is going to be no change in rates. It's a continuation of wait and see, the wait and see mode that was uh, prevalent over the last several months. But at least something new this time around might be one or two members of the committee voting to do something different. Most likely, you might see one say they would vote for a quarter percentage point cut. What's more interesting than the statement will be the post meeting press conference. And that's where you get a lot of push on the chair talking about clarity from tariff policy and trade policy. Do we have enough? If I'm anticipating some of the questions, one might be, do we have enough clarity for you, Chair Powell, to start signaling a cut in rates at the next meeting, which would be in October? Or sorry, September, I think, right? September, October, December are the remaining meeting dates. So that's going to be very interesting. In addition to that, I think there's going to be probably some questions about the release that'll happen earlier in the morning about that GDP number. We're going to have a pretty strong quarter-on-quarter number that is going to be a little bit of a head fake and just a rebound after a negative Q1. It's not going to communicate a change in trajectory. We think the trajectory for 2025 as a whole is slower economic growth, particularly as consumers are starting to slow down. We're starting to see it already. Then later on the week, you get some more inflation data and again, spending data for June. Now, to top it all off, Friday, you're going to get a couple metrics that are relevant to the month of July. So that's going to be your freshest data point. That's going to be your payroll numbers. Again, this is where we haven't seen a lot of negative surprises. Typically, when an economy is slowing, you'll get one or two really, really weak labor market reports. We haven't gotten any of those yet. So that's certainly providing some of the comfort level for investors. But we'll get the latest July figures, 8:30 Eastern time on payroll numbers, and then 10 o'clock Eastern time, you'll get the latest ISM numbers, and that correlates to, in part, to the first chart I showed about ISM and its predictive nature on overall global U.S. growth. So that's going to be important to watch. If I had to rank it, okay, Jeff, we got a lot of data, and then of course you have some earnings that you'll highlight. If I had to rank it, I'd probably say the press conference after the Fed meeting, and then probably the payroll number. And then third would be your income spending and the Fed preferreds inflation metric on the 31st, which would be Thursday morning. So there you have it in a nutshell. That's a big nutshell, but I tried to pack it all in one nut.
Yes, very well done. Well, maybe it was more like one of those edamame pods where you had several
Yeah,
packed in there,
there you
as
go.
opposed to just a nut. The GDP, I think by design, you're putting that down the rankings because, well, it's first stale data, and second, it's really a lot of just inventory adjustments and tariff front running reversals going in there,
That's right.
right? So a 2% GDP growth or 2.5 doesn't really mean a whole
Yeah.
lot.
Yeah. And just a quick little footnote, when we talk about front running tariffs, we're saying we saw in March businesses importing more than they normally would,
Mhm.
and imports subtract from GDP growth in the overall GDP calculations. Hence, you get that negative number in Q1. Less importing Q2, so less of that drag. Hence, a hotter number Q2.
And the front running was you were selling goods that had already been imported pre-tariff, generally speaking. So
Right.
that's why there's a lag, right, Jeff, in terms of feeling the tariffs and seeing them in the data. We've seen a little bit of it, but it hasn't fully flowed through.
That's right.
Right. Very important point. All right. So big finish earnings season, 164 S&P 500 companies, as if this data wasn't enough. And the court decision I mentioned, the negotiations with China, et cetera. We're going to have a lot of earnings. It's four of the Mag 7 this week. So we have Meta and Microsoft on Wednesday and Amazon and Apple on Thursday. All four after the close. The capital investment from the Mag 7 is expected to be up 40% this year versus 2024. These are big numbers. In fact, we're only going to get probably marginal capital investment increases from the 493 this year. So essentially all or almost all of the capital investment from the S&P 500 is coming from those big tech companies. So they're really, really important. So we'll see what we get. I'm going to do more of a deeper dive into earnings next week. That will certainly be covered to some extent in the weekly market commentary, where I think it's going to be kind of a recap of all these big events this week. But at any rate, earnings season off to a very good start. Estimates overall for the S&P 500 have actually ticked a little bit higher. And while the dollar has helped, remember a weaker dollar boosts revenue earned overseas. The beat rates are about as high as they ever get at this stage. We're at an 82% beat rate as of this morning. That is a really strong rate. So good results, pretty good guidance, estimates up. That is good to see. We said at the start earnings season in our preview that we would be maybe 7-8% higher year over year. We are absolutely on track to be right in there. And that's pretty good given tariffs are starting to bite. So let's leave it there. Boy, is that a chock full week ahead. Jeff, that may be a record, but we'll go ahead and wrap there. So thanks everybody for listening. Hopefully you found some interesting nuggets in there for you. We're still sticking with our neutral equity weight and neutral fixed income weight, despite this strong market rally. Looks like, I mean, this is just not the kind of rally that you want to try to step in front of. We think could go the other direction. So let it ride. So Jeff, thanks for the great economic insights as always. Appreciate it, and for helping me get through that week ahead preview. Everybody have a wonderful week, and we will talk to you next time on LPL Market Signals.
All right. Thank you.